Welcome to another tutorial video. This time around, we're going to be addressing a valuation topic that we've gotten a lot of questions on. And here's the typical question we receive on the topic. Help, how do you value a private company? And sometimes we get even more frantic questions, such as, no, I really need to know how to value private companies. They must be dramatically different, right? And we get a lot of questions on this topic. We got even more questions on this topic before we added coverage of private companies and private company valuation to one of our courses, the Financial Modeling Fundamentals one. So to answer this question and to explain more about the key points of private company valuation, I'm going to take our 10-hour-long set of tutorials and try to summarize them in 20 minutes. We'll see how that goes. In the course, we explain private companies via two case studies. The first one is about a deal between Kakao and Daum, these two Korean technology companies. Kakao was private at the time, Daum was public, and it was a reverse merger type of situation. So we look at a larger private company there. And then in the second case study, we actually turn around and value this business, the mergers and Inquisitions and breaking into Wall Street business, using fake numbers, but the principles are all the same. For the starting point here, I would suggest thinking about TV shows, and specifically one of my personal favorites, Breaking Bad. Now, in the final season of Breaking Bad, Jesse Pinkman, Walter White's accomplice, confronts him at one point and asks him about his true motivations for wanting to become a drug dealer mastermind and control large swaths of territory in the southwest of the US. Is he doing it for money? Is he actually doing it for his family? Or is he doing it for his own ego? And he responds with this quote, "You asked me if I was in the meth business or the money business. Neither. I'm in the empire business." While this is very quotable, it also is important because it touches on the three main types of private companies. So the three main categories are, first off, what we call money businesses. Now, these are small family-owned businesses or other types of firms that are heavily dependent on one person. A restaurant that is owned and operated by a top chef would be an example. Something like a law firm with only one lawyer or a few lawyers would be another example. A tax firm, a barber shop, other places like that that are actual true small businesses. Then in category number two are venture-backed startups, what we call meth businesses, because these companies are, just like Walter White in Breaking Bad, are very focused on scaling their business and getting up to a much bigger size eventually. Examples would be Kakao Talk before it was acquired, WhatsApp, Instagram, Tumblr, all before they were acquired. And then in category number three, you have the empire businesses. Now, these are large companies with boards and management teams, and they're not public yet, but they could be if they wanted to, and they might become public one day if circumstances change. So when thinking about private companies, you have to think about which category your company is in first. Because obviously a small barber shop with 2 employees is going to be valued very differently from IKEA. Yes, they're both private companies, but they're completely different in size, scale, and dependency on key people. So with empire businesses, they're really almost the same as public companies. There are some minor differences. You might apply some discounts and adjustments, but for the most part, the valuation is not that much different. With meth businesses, aka startups, the valuation is still quite similar, but you do see a few more differences. For example, it's often very important to look at an IPO valuation for these companies, which we cover in another free tutorial in this channel. And then with money businesses, in other words, real small businesses, most of the differences actually emerge here. You're going to have to adjust their financial statements. You will have to adjust the valuation. You'll have to adjust any DCF analysis that you run for these companies. Of course, you rarely actually work with these companies in fields like investment banking and private equity unless you're at a small firm that actually advises or invests in true small businesses. So what exactly is different based on those three main categories of private companies? First off, with accounting and the 3 financial statements and 3 statement projections, you will have to make some adjustments here because often the categories are not correct. Often expenses are not really relating to the business. Owners sometimes don't pay themselves. And this is mostly an issue for money businesses, in other words, real small businesses. On the valuation side, private companies are often worth very different amounts to different buyers or investors. So if a private company is about to go public, it will be worth a very different amount versus if one individual is going to acquire it or a private conglomerate is going to acquire it, for example. And then beyond even that, if you're using comparable public companies or precedent transactions to value a private company, you're going to have to apply some discounts. Private companies are less liquid than public companies because you can't just buy and sell their shares easily. And you may have to discount and adjust a lot of other assumptions and factors in the valuation. And then finally, in the discounted cash flow analysis, you run into a couple problems. First off, private companies don't have market caps, they don't have beta, and so you can't calculate cost of equity and WACC, the weighted average cost of capital, in the traditional way. So we'll look at some alternative approaches to doing that and see a few examples in Excel as well. And then the terminal value assumption can also be problematic for these types of companies. Not for all of them, but certainly for the money businesses where it's highly dependent on one person or a few key people, even assuming anything for terminal value can be somewhat problematic. So let's start with the first area, the accounting and three-statement projection differences. Then we'll get into the valuation differences, and we'll conclude with the DCF differences. Now, of course, there are differences in other areas like merger models and leverage buyout models and other types of transaction models, but they tend to be even more minor than these differences, and we just don't have time to get into them here. So I'm going to focus on these three areas, at least in this lesson. So first off, many small private companies have financial statements that don't exactly conform with GAAP or IFRS or the local accounting standards in whatever country you're in. So you may have to change around the categories and normalize them a bit. Oftentimes, small private companies do not actually record anything for the owner's salary on the income statement or whatever the owner is paying him in the form of a bonus, for example, because they will take out all the money in the business in the form of dividends. Now, the problem with this is that then when you look at the company's income statement, they seem a lot more profitable than they actually are. A public company wouldn't work like that. You would have to record all the payments to owners and managers and everyone else who is involved with the day-to-day operations of the business on the income statement. Oftentimes, small business owners will intermingle their business and personal expenses. So they'll try to expense travel or entertainment or other things like that on the income statement and call it a business expense when it's really not. And they can get away with it because your chances of getting audited are not that high unless you get to a certain size. So tax authorities sort of look the other way, and business owners can often get away with this. And then finally, tax rates can also be quite a bit different because, at least in many countries, the tax rate on small businesses will be quite different than it is on large public companies, C corporations. Oftentimes, small businesses are taxed at the owner's personal tax rate, depending on how the business is set up. But if another company is thinking about acquiring it, or if the company wants to go public, its tax rate is going to change. And so, at least in future projections, you're going to have to modify that and use a tax rate that is closer to what the acquirer or what the new investors are thinking about. So, as an example of this, let's take a look at an income statement from a typical money business. And you can see up here, we have some fairly non-standard categories. This is actually a fake income statement for our business, but I've listed as categories online courses, product sales referred by affiliates, coaching and resume editing, sales to institutions, commissions from other products, commissions by category, gross sales less commissions, and then fees and refunds, and then net sales after fees and refunds. As you can tell, it's not exactly presented in a way that's compliant with GAAP or IFRS. And that's because for me, as the business owner, it's easier and more effective to look at it like this. I like to see commissions by category, and I like to see the refund amount, the amount that we're paying in fees. And I pay a lot of attention to this number, the net sales after fees and refunds number. Of course, in the real world, an accountant or auditor would probably reject this and tell me that I have to list gross sales and net sales, and I shouldn't even be listing commissions here. I shouldn't be listing payment fees. It should really just be gross sales, and then you subtract refunds to get to your net sales at the bottom of that. The expense categories are also a little bit weird. We don't have general and administrative, sales and marketing, research and development. Instead, we've split things into much more granular categories down here. Also, if you notice, none of these categories actually has quite a lot in spending, and that's because my own salary is not included here. Since I am taking money out of the business in the form of a dividend or some type of annual bonus payment I pay to myself, I'm not even listing it on the income statement, and I don't think of it as an ongoing business expense. But of course, again, if we were acquired by someone else, or if we eventually wanted to go public, if we got much bigger, we'd have to list that, and we'd have to count my own salary somewhere here. And then finally, the income tax rate here is quite a bit lower than what it probably would be for a large public company. The effective tax rate is around 25 to 30%. Most public companies are taxed at more like 35 to 40% in the US, so this is something else that we'd have to adjust in future periods. So those are the main problematic areas. To adjust for all that and to come up with a normalized version of the statements, we might have something like this, where we list gross sales and net sales at the top, and all we do to move from one to the other is subtract refunds and allowances. And then we might put all the operating expenses in more normal categories. We'll take out anything that's intermingled, like travel expenses, and we'll also add in my own salary and allocate it to these categories as appropriate. We didn't change anything with the taxes in the historical period because those are historical taxes, they've already been paid, but certainly in future periods, we'll probably adjust up the tax rate here. So that's a quick summary of how you might have to normalize the financial statements for a true small business. Again, you're not going to have to deal with most of these items for empire businesses or meth businesses. They could come up, and occasionally you will see some non-standard things, but it will be far less of an issue than it will be for these true small businesses. Let's move into topic number 2 now and look at valuation for private companies. So first off, you have to think about the purpose of the valuation. For example, if you're valuing the company because it's about to go public, you're probably not going to discount it as much as you would if you're valuing it because it's about to be acquired by another private company or even by a large public company or by an individual. The reason is because once it's public, it gets a diversified shareholder base. It is run more like a public company because it is a public company. And so you're not going to have to discount things quite as much. As an example, in one of our case studies for Cacao and Daum here, you can see that in one of our cases, when the company goes public, we don't actually apply much of a discount for the comparable public companies. But then if it gets acquired by some other company, a private company or another public company, we actually apply far more of a discount, 15% instead of 0. Now that discount I just showed you is the illiquidity discount, and you almost always apply it to public comps when you're using them to value private companies. The logic is pretty simple. Any investment in a private company is less liquid than buying a public company's shares. It's much harder to sell, and therefore you're taking on more risk, and so the company is probably going to be worth less to you. Now the actual range for the discount might be anywhere from 10% to 30% or more, sometimes less as well. It really depends on the size and scale of the company and the purpose of the valuation. So again, if the company is large and about to go public, it's going to be smaller. If the company is very small and a single individual wants to buy it, it's probably going to be a much higher discount. So it depends a lot on the type of business and also how and why you're using the valuation. With public company comparables, you can still come up with a set. In this case, we're looking at for-profit education companies, and you can still use the same types of metrics and multiples, revenue multiples, EBITDA multiples, PE multiples, but you have to discount them by some amount if it's a true small business you're looking at. Because if your company has $5 million in revenue or $500,000 in revenue, you can't really compare it to a $500 million revenue company, so you have to apply some type of discount to these multiples. Here's an example for our valuation of this business. We're applying a 30% private company discount. So when we get a multiple like 6x, we're not going to take that at face value. We're going to have to reduce it by 30%, and that's what we're going to use to get to the company's implied enterprise value and implied equity value across these different ranges. Now, you're not necessarily going to apply the same discount for the precedent transactions because these should already reflect some type of premium paid by the buyer. And once a company is acquired, by definition, it is now illiquid. So you're not necessarily going to apply it there. You could still do it if the companies that were acquired in these deals are really not comparable to your own at all. You're generally not going to apply this same type of discount to empire businesses just because they are so much larger and they're probably more similar to the precedent transactions. You will probably still apply some type of small discount for the comparable public companies, but again, it's just going to be a lot lower than it is here. You might see 5%, 10%, 15%, depending on the type of business. For precedent transactions, not too much is different, but you might use some more creative metrics, especially if you're looking at a tech startup, for example. Here's our list of comparables for Kakao. And as you can see, we're looking at monthly active users and also enterprise value to monthly active users. Now, Kakao and actually most of these companies were generating some amount of revenue. But the reason we're looking at this is because for social media and gaming and mobile companies, monthly active users is a very important metric, and it's useful to look at a slightly different valuation method. With that said, let's now move into part 3 and look at some of the problems with the discounted cash flow analysis, the problems that emerge and some of the differences here. So the first problem is the discount rate. Now, the discount rate should be higher for a private company because you're taking on more risk. It's harder to sell your shares if you can even somehow acquire shares in the private company. If there's more risk, the returns need to be higher, and so the discount rate needs to be higher as well. Of course, it's difficult to calculate this when the company doesn't have a market cap or beta, so you have to think about some different approaches. The second problem is terminal value. Now, it's similar for empire businesses and for some types of venture-backed startups, but it has to be discounted for money businesses, because if the owner of a business that's heavily dependent on him or her dies or quits the business or retires or does something else, the business may not actually last. So you have to factor that in and rethink some of the assumptions that go into terminal value. So with the discount rate, there are a number of approaches you could take. First off, you could just look at the industry average capital structure, or you could look at the average capital structure for the comparables. You could try to look at the firm's optimal or targeted capital structure, what it's moving toward in the future. You could even use circular logic, where you calculate the implied equity value from the DCF and then you feed it into the calculation for WACC. I don't recommend this because it's unnecessary and it makes your model more complicated for no real benefit. You could also even look at the volatility of earnings or the dividend growth rate or something else like that and get to a number like beta from that. This is a little bit questionable as well, and I haven't really seen it done in real life before. Really, the main way to get around this for all these types of businesses, empire businesses, meth businesses, and even money businesses, is to, as we do here, take the median capital structure of the comparables. So what we label the optimal capital structure on this page, we've really just taken the average percent debt from the comps, the average percent preferred stock, and the average percent equity. And then we've assumed that they also apply to our company here. So we don't need their current capital structure. We don't need their current market cap. We're just taking the industry average for these for-profit education companies and going with that. Now, at this point, you could also theoretically apply some type of additional premium to the discount rate. And you could say that since it is a private company, it's very small, it's worthy of another premium, and the discount rate should be even higher than 14 or 15%. We don't think it's entirely necessary here, but some people will also make that adjustment. Now, for the second problematic part, terminal value, it may or may not make sense for a true small business, and it sort of depends on just how reliant it is on a key person, key individuals, or key customers. You could adjust for this by heavily discounting the terminal value. You could also skip terminal value entirely and project free cash flow far into the future, sort of like what you do with a net asset value model for a natural resource company. Or you could just assume that terminal value equals the liquidation value in the future. So the business shuts down, it sells off its assets, it uses them to repay its liabilities, and then whatever's left over is the company's terminal value at that point in time. There are advantages and disadvantages to each of those methods. You can see them lined up side by side here in one of our examples. But the basic advantage of simply discounting the terminal value as we do right here is that it is fairly straightforward to justify because you're still calculating it in the same way. It's just you're reducing the value at the end. The disadvantage is that the exact discount, of course, is arbitrary, and so it can be harder to justify. The liquidation value method is nice because then you don't have to make any assumption for terminal value, but then you have to estimate how long the business is going to last, and you have to project its full balance sheet going into the future. And then finally, the cease operations method is nice in some ways because you can avoid some of the arbitrary assumptions that go into terminal value. But then once again, you have to estimate how long the business is actually going to last going into the future and how much its free cash flow is going to decline when the owner becomes less active in the business. So there isn't a clear winner, but there are a couple different ways to think about it, and you could use any of these or all of these potentially as you're thinking about terminal value in a private company valuation. The main point, though, is that the company is just not going to be worth as much as a public company would be, particularly when you get far into the future and the owner and the key people involved with the business decide to become less active with it. So that is a quick overview of private company valuation. I tried to hit on all the key points here in about 20 minutes. Let's do a quick recap and summary now. With private companies, you have to ask what type of company it is and also what the purpose of your analysis is. When you're dealing with an empire business, a large private company, there aren't that many differences. You will see some minor discounts and adjustments, but that's about it. With meth businesses, venture-backed startups that want to become big one day, you'll see some greater discounts and adjustments there. But in general, since the end goal is to become a large business, you won't see dramatic differences quite as much. You will see a lot more differences with money businesses, true small businesses, because you'll have to discount the comp's multiples significantly, you'll have to discount terminal value or look at it or calculate it in a different way, and so on and so forth. There aren't really new methodologies or multiples with private companies, they're just variations and tweaks of old ones. The basic point is that private companies are generally worth less than public companies of the same size, simply because they're riskier, they're less liquid, and so your returns expectations have to be higher as well. On the accounting side, you often tweak and reclassify the statements, especially for small businesses. And then on the valuation and DCF side, you will often apply illiquidity discounts. You'll have to make rough estimates for the discount rate, and you may have to discount terminal value, skip it entirely, or come up with some other method of calculating it. So that's it for our tutorial on private company valuation. I hope you understand this topic more and can now answer some of your own questions whenever a question related to private companies comes up.